Welcome to Investors Insights, episode 155.
Wow.
Please keep sending us your comments and questions. They help us bring you the information you want. We also want to let you know that we sent an email out last week regarding our webcast that Greg and I did. It's about an hour-long presentation about our thoughts on the current markets. And so if you did not get the email, you can check our Facebook page as well. With that said, we have some good information to share with everyone, so let's jump right in.
You're listening to Investors Insights with Greg Powell and the Portfolio Strategy team from Five Plan Partners.
We hope everybody had a great Easter weekend. Greg is out with clients this morning, so it's just the three of us. And a lot of information to go over, a lot of domestic economic reports, international. So let's start with domestic. Ashley, talk about some domestic economic reports.
Yeah, we were talking about that this morning. A couple of data points came out, one in the service sector, one in the manufacturing sector, or to be more specific, durable goods order sector. And kind of putting that together suggests that we're going to have a quarter of about 0.7% GDP growth. The service sector is still positive, but just barely. And when you look at a sector like that, it's a combination of amount of hire versus productivity. The job growth is still there in the service sector, we found, but the productivity is leveled a little bit. That's on the service sector side. On the durable goods order side, we had noticed there was a very good January in that. It was up about 3-4%. It was off a good bit in February, but one thing that you have to do in the durable goods orders, you have to take transportation out because it's very volatile. But if you smooth out that transportation impact, it was down about 1%. So if you look at that in combination, the durable goods orders was flat a little bit, service sector is flat, and that's kind of adding up to a first quarter that's just anemic growth. And we seem to have had that theme for quite a while.
Yeah, and last week also some housing numbers came out lower than expected.
Yes.
This morning consumer spending came in about flat from last month.
Yeah.
And so
really okay, not great.
Yeah, it's a lot of mixed messages out there in terms of economic reports.
Not declining, but really not picking up steam to kind of get growth where you want it.
Yeah, you don't seem to have the breakthrough moment yet, is what we're noticing.
And then Trey, talk about international. We've had a lot of international news come out the past 2 weeks.
Yeah, so two real big news points came out over the weekend and are expected to materialize this week. One is that 250 business leaders got behind the Brexit or British exit from the EU over the weekend, and that's showing that business is getting behind it. That was surprising to see. And then over the weekend, Prime Minister Abe from Japan is expected to announce stimulus sometime soon this week to try and help their economy, which has been shrinking of late. The reason those two impact your portfolio here, is because both of those harm their local currencies. The British exits the European Union. That hurts the euro. It hurts also the British pound. And then further stimulus, that's printing money, that reduces the yen. And what we've seen so far year to date is when the dollar strengthens relative to the other currency, oil falls and our market falls.
Right. Yep.
And so you think, strong dollar, that's good. We get the, imports are cheaper, but with our market tracking oil, that kind of has tended to cause our market to fall. And so that's how, these two events that are completely separate can come together and impact our portfolios here in the U.S.
Yeah. And we also had a good client question last week, obviously with the terrorist attacks in Brussels. The question was, do terrorist attacks cause a bear market? And so, really going back to 1970s, they don't. Terrorist attacks usually don't. Usually the market shrugs it off. September 11th was one off, and then the markets were down about 12% 5 days after September 11th attack. So usually they don't. They shrug it off, as it did last week with the Brussels attacks. Really, the only concern we would have with a terrorist attack would be if they attacked our infrastructure, whether it's a power plant, where they hacked a power plant or something like that. So usually they do not cause bear markets. And so that's a good question. So keep the questions coming. Thank you for watching. Please let us know if you have any questions. Have a great week.
More information at fiplanpartners.com. Securities offered through LPL Financial, member FINRA, SIPC.